Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Celsius Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For, anyone who's been tracking the beverage space, the whole bull case for this company really just comes down to their Q3 2025 results.
Right.
They put up a quarter that was it defied gravity, and we really need to unpack those numbers first.
Gravity defying is, I think, the perfect way to put it. I mean, you look at their headline numbers, and it suggests this isn't a startup anymore. This is a major market takeover in progress.
For sure.
We're talking about revenue hitting, what, $725 million?
$725.1 million, yeah. And year over year, that's a staggering 173% increase. The market knew growth was coming, but even with those high expectations, they still beat the consensus estimates by over 1.3%. They're not just playing in the energy drink space. They are, fundamentally changing its growth curve.
Okay, but high revenue can sometimes be just a vanity metric if it's not profitable. And this is where it gets really interesting for me. When you look at the bottom line, their adjusted earnings per share.
Yeah, the EPS, which, strips out all the one-time noise.
Exactly. It shows you the real operational health. And it came in at 42 cents.
And the street was only expecting 28 cents. That is a 50% beat on earnings.
The 50% beat.
It tells you two things. One, the growth is actually translating into profit and efficiently. And two, management is either being super conservative with their guidance or they're just executing way better than anyone gives them credit for.
Right. And earnings beat like that, it suggests their operational leverage is really starting to kick in.
Absolutely.
So let's dig into that efficiency a little more, because that's always the big question with these super fast-growing companies. We saw a huge expansion in the gross margin.
A huge expansion. It jumped up to 51.3%.
So 51.3. That's up, what, 530 basis points from last year?
530. And for anyone who doesn't live and breathe this stuff, that is an incredibly significant jump. It's a 5 percentage point increase in how much profit they make on every single dollar of product they sell.
That's huge. What's driving that kind of surge? Is it just volume or something structural changing in the business?
It's a mix of both, really. First, it's a favorable product mix. The stuff that's selling the best is their higher margin core drinks, the fitness-focused ones.
Okay.
And second, you're seeing real operational efficiencies. This is likely where that huge PepsiCo distribution deal comes in, helping them lower all those per unit costs for manufacturing and logistics.
So the profit machine is just getting more and more efficient. And that efficiency, plus the sales growth, it pushed their adjusted EBITDA to $205.6 million.
Which is a 152% growth year to date. And that high EBITDA is critical. That's the fuel they need to keep this fire going, buying up smaller brands, moving into new markets.
Like funding that aggressive expansion.
Exactly. They are building scale, but they're funding it with profitable sales, not just by taking on a mountain of debt.
Well, speaking of debt, whenever a company grows this fast, you have to check the balance sheet. Is there some hidden risk there?
And when we look at their financials, they look pretty solid. Their current ratio is 1.89, which signals really strong liquidity.
So they can cover their short-term bills easily.
Very easily. And their debt-to-equity ratio is low. It's at 0.29. They just aren't relying on borrowed money to run the company.
And I saw they've been cleaning that up, too. After the quarter, they made that move to reduce debt by $200 million.
That's a perfect sign of a proactive management team. That single move is going to cut their annual interest expense by $20 million starting in 2026.
And $20 million might not sound like a lot next to their revenue, but that's a saving that flows straight to the bottom line. It's pure profit.
It is. Now, we have to talk about the elephant in the room, the thing that caused that huge market overreaction.
The reported loss.
The reported loss, yeah. The GAAP net income showed a loss of $61 million. And if you just read that headline, you'd be thinking, how can they be losing money with this kind of growth?
This is such a critical point to understand. And it's where I think a lot of people got tripped up by the accounting.
Totally. That loss was almost entirely from one single thing. A $247 million charge for distributor termination expenses.
That just sounds expensive.
Well, it was less of a mistake and more of an investment. Celsius had to pay that fee to get out of all these old, messy distribution deals.
So they could consolidate everything and move it all over to the PepsiCo system.
Exactly. It's the cost of upgrading to the best-in-class distribution network.
It's like paying a penalty to break your apartment lease early because you're moving into a much better house for the long term. But did that $250 million payment come out of their own cash reserves?
And that is the single most important takeaway from the report. The charge was cash neutral,
Cash neutral.
which means the $247 million didn't drain their daily working capital. It was all financed from within the PepsiCo partnership itself. It shows up on the books as a loss because accounting rules say it has to, but it didn't drain their actual cash.
That makes all the difference.
Yeah.
So a financially healthy company took a big accounting hit to lock in a massive strategic win.
That's the story.
Okay, so let's move on from the numbers to the actual product. I mean, the energy drink market is brutal. What's their competitive moat against giants like Monster and Red Bull?
I think their core strength is just genuine brand differentiation. They very deliberately did not go after that traditional high-sugar, aggressive energy drink branding. Celsius is all about the zero-sugar, vitamin-infused, fitness-oriented position.
They completely own that Live Fit identity. I see their cans everywhere, in gyms now, in wellness circles. It's really taken hold.
And that's a powerful moat. They're not just selling a can of energy, they're selling a lifestyle. And they have IP protection around their formulas and their marketing. So while Monster and Red Bull are giants, they're playing a slightly different game. Celsius created its own niche and is now dominating it.
And that unique brand position lets their distribution strategy just sing, that
Yeah.
PepsiCo partnership.
Yeah.
It's not just about getting product out there. It's about getting access to the DSD network.
The direct store delivery network. It's the holy grail in the beverage world. It means PepsiCo themselves are stocking the shelves, managing inventory, fighting for that prime eye-level placement.
Which is so crucial for an impulse buy like an energy drink.
It is, and we're seeing them integrate their acquisitions like Alani Nu into that same powerful system.
But we have to look at the whole picture. The Q3 data showed their U.S. scanner growth was 13%, which is great. But the whole energy category grew at 31%.
Great.
So that kind of suggests that their momentum, while still huge, maybe slowed down a little bit relative to the market's blistering pace.
And that's really the first hint of the bear case. The volume is enormous, but that relative growth number suggests the whole category is heating up really, really fast. So with that complex story, let's look at how the stock has actually been behaving.
Well, it had a monster run leading up to this. Through Q3, it was up 62.5% for the year, basically leading the whole soft drink sector. The technical chart looked great. You had the classic Golden Cross pattern.
For our listeners who might not follow the technicals, can you just quickly explain what the Golden Cross is and why it's a bullish signal?
Sure. It's when the stock's shorter-term moving average, usually the 50-day, crosses above its longer-term 200-day average. It's a sign that the recent buying momentum is strong and sustainable, confirming a solid uptrend.
But what's so fascinating is what happened when the actual Q3 report came out. Despite all the underlying strength we just talked about, the stock got hammered. It dropped, what, 17.5% in the pre-market?
That's the kind of volatility you get with high-growth stocks that report complicated numbers. The market tends to shoot first and ask questions later. But now we're starting to see accumulation signals again, which tells me the big money is figuring out the real story.
That institutional conviction really backs that up. I mean, institutional ownership is super high at almost 61%.
So the smart money's holding on.
They're holding firm, and in some cases, they're adding. We saw Osaic Holdings add over 65,000 shares, and Fluent Financial started a whole new position worth over $2.5 million.
That kind of cluster buying is a huge vote of confidence. It says they believe in the long-term execution story over the short-term accounting noise.
Exactly.
But let's be fair and look at the other side. What are the main risks here? What are the more skeptical analysts worried about?
The biggest concern is around integration costs and margin pressure in the short term. That $247 million expense, even being cash neutral, it just highlights how complex this transition is.
Okay.
And there's an expectation that Q4 gross margins might dip a bit because of more promotions to win shelf space, maybe higher freight costs during the transition, things like that.
So the fear is that the costs of all this growth might start to eat into that amazing profitability we saw in Q3. What's the second big risk?
Valuation and volatility. The company trades at a really high premium because of that 173% growth.
Hmm.
When a stock is valued that richly, any little hiccup like that post-earnings drop just hits so much harder.
Right, a high multiple demands perfection.
It really does. And the mixed views from analysts just adds to that volatility.
So if we tie this all together, why might these risks be manageable?
Well, because the biggest risk, that integration cost, it's already been handled. The fact that it was cash neutral because of the PepsiCo funding means that huge financial hurdle is already in the rearview mirror. And second, the company's track record. That 50% EPS in Q3 shows they have the operational chops to handle these big strategic moves. This isn't a struggling company trying to grow. It's a highly successful company that's leveling up.
That's a great way to frame it. So looking forward, what are the key catalysts we should be watching for over the next, say, 3 to 6 months?
All eyes are on the Q4 2025 earnings report. That's probably coming around February of 2026. Consensus revenue is just under $690 million, but the key thing to watch won't just be revenue. It'll be margin recovery.
Do they stabilize margins after that expected dip in Q4?
Exactly. If they show margin resilience, it proves the whole thesis. And beyond the numbers, we need to see real integration updates. We expect the Alani Nu transition to the PepsiCo DSD network to be complete in Q4.
And when that engine is firing on all cylinders, we should see new efficiencies.
For sure. And we also can't forget the macro environment. We're seeing some rotation into consumer staples, which favors brands like this. And any hint of interest rate cuts is generally good for high-growth companies.
Plus, there's always the chance of a surprise. You hear some chatter about PepsiCo leveraging its network for some unannounced distribution wins, maybe internationally or in big U.S. chains where Celsius wasn't strong before.
That's the optionality that keeps these stories so compelling. The market loves a positive surprise.
So to kind of wrap this up, this isn't a short-term trade. This feels like a multi-year hold.
Absolutely. The company is set up for outperformance, and it has that huge institutional backing. But its success over the next year or two really hinges on how well they execute this massive transition with PepsiCo as we head into the 2026 earnings cycle.
And at the end of the day, you just can't ignore the number we started with. 173% revenue growth. That's what solidifies their position as a true market disruptor. You'll want to keep an eye on those integration updates for sure, especially around Q4 margins. If they stick that landing, this growth story has a lot more room to run. Make sure you subscribe to our channel so you don't miss our next analysis.